Hi students, a very warm welcome in this class. I'm Helishan. In today's topic, we are going to discuss about Tripura Civil Service Examinations syllabus, paper 4, section B. Okay. So in the paper 4, section B, one subsection is there that is called fiscal policy, right? So fiscal policy deals with the revenue and expenditure policy of the government. The word fiscal has been derived from the word fisc, which means public treasury or government funds. Objectives of fiscal policy: higher economic growth, price stability, reduction in inequality from the society. Right? The above objectives are met in the following ways. Consumption control, this way the ratio of savings to income raised. Rising the rate of investment, taxation, infrastructure development, imposing of progressive taxes, exemption from the taxes provided to the vulnerable classes, heavy taxation on luxury goods, discouraging unearned income. Right? Okay. Next, fiscal policy. So we have some components in the fiscal policy. So what are the components of fiscal policy? There are three basic components of the fiscal policy in India: government receipts, government expenditure, public debt. All the three received or all the three expenditure of the governments are credited or debited from the following funds. What are they? First is called Consolidated Fund of India, that deals with Article 266 as per Indian Constitution. Contingency Fund of India, that deals with Article 267 as per Indian Constitution. Public Accounts of India, that deals with Article 266 Clause 2. Right? Now, we need to know fiscal policy. There are two recipients. One is revenue receipt, one is capital receipt. Okay. How government earns from the various way, that is called government receipt. Governments earn revenue receipts. So in the revenue receipt, government earns by tax revenue and non-tax revenue. So in the tax revenue, government earns by direct tax and indirect tax. In the non-tax revenue, government earns by fees, various license and permits, various fines and penalties. Right? In the capital receipt, government earns from loan recovery, disinvestments, borrowing, and other liabilities. So what is the meaning of disinvestments? See, when the government sells or liquidates its asset of central and public sector enterprises, state public sector enterprises, or other assets, it is referring as disinvestments. Okay. This approach caters to the objective of fiscal burden reduction. What is debt trap? See, debt trap is a situation where the borrower has to borrow again and again for the payment of an installment on the previous debt. A borrower unable to meet debt services obligations without borrowing is known to be in a debt trap. Right? Okay. Next, that is called expenditure, government expenditure. There are two classifications of public expenditure. One is called revenue expenditure, another is called capital expenditure. In the revenue expenditure, we have interest payments, defense expenses, salaries, pensions, wages. It is the recurring expenditure, right? And capital expenditure we have, it is a non-recurring expenditure, that is loan repayments, loan to public enterprises. Okay. So next, what is the meaning of fiscal consolidation? The measures that are taken to improve the fiscal deficit comes under the process of fiscal consolidation, right? Through fiscal consolidation, the government tries why we need fiscal consolidation. We need to improve the revenue receipt. We need to improve better alignment in the public expenditure. Okay. So government was introduced Fiscal Responsibility and Budget Management Act, that is in abbreviation form we can say FRBM Act, in 2003 was enacted, okay, for better alignment of the public expenditure. See, the primary objectives was the elimination of revenue deficit and bringing down the fiscal deficit. The other objective included also introduction of the transparent system of fiscal management within the country, ensuring equitable distribution of debt over the years, ensuring fiscal stability in the long run. The act also intended to give a required flexibility to the central bank for managing inflation in India. The basic features of the FRBM Act is just like that. It was mandated by the Act that following must be placed along with the budget documents annually in the Parliament. Macroeconomic framework statement, medium-term fiscal policy statement, and fiscal strategy statement. Okay. It was proposed that the 4 fiscal indicators, number 1, that is revenue deficit as a percentage of GDP, fiscal deficit as a percentage of GDP, tax revenue as a percentage of GDP, and total outstanding liabilities as a percentage of GDP be projected in the medium-term fiscal policy statement. Fine. Okay, next. The targets and fiscal indicators as per the FRBM Act. Government is required to a threshold or limit the fiscal deficit to 3% of the GDP by March 31st, 2021. Government is required to limit the debt of the central government to 40% of the GDP by the year 2024-25. Okay, next we go through what is the meaning of fiscal federalism. See, fiscal federalism is nothing but the distribution of all resources among the union territories and states. Okay, so as per Indian Constitution, there are 7 schedules, okay, of the Indian Constitution. There are 3 lists where the taxes are distributed. One is called union list, second is called state list, third is called concurrent list. So fiscal federalism is nothing but it is a distribution of taxes between center and state. It is also mentioned in the 7th schedule of the Indian Constitution. Okay, so it is end for the today. Okay, so thank you so much. I believe all of you are enjoying this class. If you have any query, any doubt, any question, please comment on the chat box, and thank you so much.